So, what exactly is impairment? Imagine you own a high-tech machine for your business. You bought it for $100,000. But now, a newer, much more efficient model has come out, making your machine less valuable. Or maybe demand for the products your machine makes has plummeted. In simple terms, your machine isn't worth what it used to be. The carrying amount on your balance sheet is higher than what you could actually get from using it or selling it. IAS 36 is the accounting standard that tells us how to deal with this. It ensures that a company's assets are not carried on the balance sheet at more than their recoverable amount. Think of it as a reality check for your assets' values. So, how do we know if an asset might be impaired? The standard gives us some clues, or what we call indicators of impairment. There are external ones, like a significant drop in the asset's market value, negative changes in the economy or technology, or an increase in market interest rates. And there are internal indicators, like physical damage to the asset, plans to restructure the business, and stop using the asset, or evidence that the asset's economic performance is worse than expected. If you spot any of these red flags, it's time to perform an impairment test. This brings us to the big question: how do we calculate the impairment loss? First, we need to determine the asset's recoverable amount. This is the higher of two things: its fair value less costs of disposal and its value in use. Fair value less costs of disposal is pretty straightforward. It's the price you could get from selling the asset in an orderly transaction, minus any direct costs of selling it, like legal fees or removal costs. Value in use is a bit more complex. It's the present value of the future cash flows you expect to generate from continuing to use the asset, including the cash flow from its eventual disposal. ULL need to estimate future cash inflows and outflows, and then discount them back to their present value using an appropriate discount rate. Once you have both figures, you pick the higher one. That's your recoverable amount. Now, you compare this recoverable amount to the asset's carrying amount, the value on your balance sheet. If the carrying amount is greater than the recoverable amount, you have an impairment loss. The loss is simply the difference between the two. Let's walk through a quick example. The recoverable amount is the higher of the two, so that's $40,000. Now, compare this to the carrying amount of $50,000. Since the carrying amount is higher, we have an impairment loss of $10,000. This $10,000 loss is recognized immediately in the profit or loss statement, and the asset's carrying amount is written down to $40,000. What if the situation improves later? Can we reverse the impairment? Yes, in many cases, you can. If the recoverable amount of the asset increases, you can reverse the previous impairment loss, but only up to what the carrying amount would have been if no impairment had been recognized in the first place. You can't just inflate the asset's value beyond its depreciated historical cost. And that's a whirlwind tour of IAS 36. It's all about making sure financial statements reflect the true economic value of a company's assets.